Have you ever wondered how to find a good stock to invest in, especially during a recession? With so much news surrounding layoffs and also disappointing earnings reports from major corporations, one might question if a recession is around the corner. The stock market has been looking shaky for the past few months, and even though there are still investors buying, most of them are already on the sideline or selling. Well, even the renowned investor Warren Buffett is at the buying party, of course, as he said.
What gives you opportunities is other people doing dumb things.
What most people didn't recognize is that market downturns often present many opportunities, but they tend to stop investing then, which is a common mistake that you want to avoid. But then you might ask, what's the secret to finding a good stock to invest in, especially in times like this? One common mistake that people usually make is overly fixating on stock picking and short-term price movements. But isn't it wiser to focus on understanding the businesses behind those stocks? Because if you don't understand the company, you will panic sell when the stock market dips. It's only natural.
If you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now.
And this brings us to the concept of investing in companies with an economic moat, aka competitive advantage. It is a barrier that protects a business from its competitors. During a recession, companies with strong economic moats can often weather through the storm better than others, thanks to the unique qualities of the business, which we'll explore in just a bit. But why is an economic moat so important? Well, it all boils down to sustainability, safety, and growth. A company with a wide economic moat is better equipped to withstand competition and changes in the market, hence generating consistent profits year after year, which will then drive its stock price up. For example, Tesla's Gigafactory is a powerful moat because of its constant innovation and also high manufacturing efficiency. Hence, they can produce cars at a lower cost, allowing them to achieve a higher profit margin than competitors. And with this strength, Tesla can cut their prices during high inflation era to attract more buyers and increase its sales volume. And when you're investing, you want your money to be invested in a strong, resilient company, especially one that can keep growing and thriving even when times get tough, because they have a cost advantage over the competitors. So back to the topic of economic moat, it often refers to companies having a well-known and trusted brand, a product that cannot be easily replicated, or the ability to produce goods more cheaply than others. And while being a first mover, i.e. the first company to introduce a new product or service in an industry or market, can be seen as a type of economic moat, it doesn't necessarily guarantee a long-term competitive advantage. Because look at Motorola, being the first in creating a mobile phone but still nowhere near Apple or Samsung today. And that's why what we are seeking here is a durable moat, one that competitors find it nearly impossible to replicate, and this is no other than the big brand moat. But before we explore further about big brand moat, I would like to give a quick shout out to Moat, a brokerage platform that provides you advanced charting tools, analysis, and also smart indicators for you to identify stock price trends easily and faster, both on their mobile app as well as their desktop trading platform. Plus, they provide you free 24/7 market news coverage from various reliable resources such as Bloomberg and CNBC, so you would not miss if there's any important updates in the market. Feel free to use my affiliate link down below to get free stocks and some other rewards. And thank you Momo for sponsoring this video. Alright, let's get back to the video. Let me ask you a question. Have you ever found yourself instinctively reaching for a Coca-Cola instead of a Pepsi? Or maybe you have opted for an iPhone even though there are so many other brands like Samsung or cheaper alternatives like Xiaomi. If you answered yes either of those questions, you have experienced the undeniable influence of a big brand moat. Companies like Apple and Coca-Cola have become household names all around the world, and that's not by accident, because they have spent a lot of time and money building their brands, making sure the customers associate them with quality, reliability, and even a certain lifestyle. And I'm sure you guys know me as an Apple fanboy, and I'm totally cool with paying a premium for their products, because I know for a fact that what I'm getting in return is nothing less than high quality and exceptional user experience, and that to me is more valuable compared to saving the extra 20-30% for a cheaper product. You see, Apple provides an ecosystem that is so powerful that their products and services are designed to work seamlessly with each other. My iPhone and iPad syncs effortlessly with my Mac. I can start a document on my Mac and finish it on my iPad, or copy paste anything from my iPad to my iPhone just like that. And all these unique user experiences are hard to replicate and you won't be able to find it in other brands. I mean, just try Microsoft or Google. You will get what I mean. So this cohesive Apple ecosystem creates a kind of stickiness for customers, and once you buy one Apple product and experience this seamless integration, you are more likely to buy other Apple products to complete the ecosystem experience. And the more products you own, the harder it becomes to switch to another brand. After all, would you want to give up the convenience and functionality that you are so used to? I definitely wouldn't. And voila, you see how Apple successfully fosters customer loyalty through this approach to their brand. It is a key reason why it has been and still is one of the most valuable companies in the world today. And if you are from Malaysia, I'm sure you are familiar with Maybank. That's a very good example of a Malaysian company with a strong brand moat. They have significant brand recognition, extensive network and ATMs all around the country, 24/7 customer support, and constantly innovating in the form of Maybank May, buy now pay later service like EasyPay, etc, etc. Might not be perfect today, but you can't deny the fact that they are still standing strong today as the most valuable company in Malaysia. But here's the thing, no matter how wide, how deep or how formidable a company's moat may appear, it is not invincible. Competitors can still emerge and overtake even the strongest company. So as an investor, we need to keep an eye on our investments and continually re-evaluate the companies by asking critical questions like, are the companies innovating and adapting to new technologies and market trends? Are they still staying ahead?
We are trying to figure out why is that castle still standing? And what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now?
And I understand that asking these questions may seem like predicting the future, but we do not have a crystal ball for that. It's an almost impossible task given that investing is all about what's going to happen, not what's already happened. But that said, studying the past is equally important too, as it can give us really valuable insights into a company's performance and stability. You can examine the company's trends over the past 5 to 10 years to get a snapshot of how they handled various market conditions. Have their earnings shown consistent growth? How stable is their cash flow? Taking Apple as an example, both their net income and free cash flow have consistently grown over the past decade. On the other hand, if a company is experiencing declining income without a good reason, such as investing in R&D or acquiring more assets, etc., you might want to avoid them, and one such example would be Nokia. They had a strong moat and was once a global leader in the mobile phone industry, but when Apple and Samsung introduced smartphones, their lackluster Symbian operating system OS simply wasn't ready to compete at all, and that led to the decline in Nokia's market share and profitability, and ultimately, you all know already, they had to sell their phone division to Microsoft. So that being said, let me also remind you that investing is not a one-off thing. It is an ongoing process of evaluation and re-evaluation. You want to invest in companies that can continuously innovate and adapt to the changing market conditions, which can be a challenging one for many growth companies in the beginning stage. And that's why it is also important to have a longer horizon, which brings me to my next point, the power of long-term investment. Imagine if you invested $1,000 in Apple when Warren Buffett did in 2016, which is about 7 years ago. Your shares today will be worth over $6,000, giving you an incredible return of 533%, provided that you did not panic sell your shares during the 2018 to 2020 bear market. But hindsight is 2020, right? My point is, investing in a longer term allows your investment to grow through the power of compounding, where you will see your money snowball over time, smoothing out all the market's ups and downs. And even if you accidentally bought a stock at a high price, holding onto it for a longer period can still lead to profits. But of course, I'm not suggesting you to just randomly buy into every overvalued stock today. Valuation still matters. And interestingly, even legends like Warren Buffett himself make mistakes and admitted that selling some of the Apple shares in 2020 back then was probably a mistake which cost Berkshire Hathaway up to $18 billion. And according to Business Insider, if Buffett had held onto those shares, his position today could have surged to $146 billion instead of $128 billion. Still an absurd amount, but it's a valuable lesson for all of us regarding the importance of a long-term game. And given the current market sentiment with talks of a possible recession and geopolitical fragmentation and wars, etc., it could be a good time for us to invest or load up on stocks of solid businesses that are priced reasonably or cheaply. Remember, Investing is not equivalent to trading where you actively sell at the highs and buy at the lows. It is part and parcel of the process to weather through the storms and capitalize on the bull market that follows afterwards. So during times of high inflation and uncertainty surrounding a recession like right now, it's totally normal to feel hesitant about entering the stock market. Of course, you do not have to invest all of your money at once all in, but it is crucial to take small and immediate action by learning and researching companies with good economic moats, such as the big brand moat that I've mentioned to you earlier. And when opportunities present themselves, it's your time to strike. That's all for this video. Hope you find it helpful. Help me hit the like and subscribe button down below, and let me know in the comments if you have learned anything new or would like to share any of your investment experience. Thank you for watching, and as usual, I will see you in the next one.